Welcome to ALU Speaks with ALU Patience. Our topic for today is capital structure. This is the second topic on Module 3 in the course Corporate Finance. If you have not watched our previous topics, I would advise you to do so. However, do not worry. I will be breaking down today's class to be as simple as ABC. At the end of today's class, we should be able to state the meaning of capital structure, emulate the factors that determine capital structure, evaluate a company's capital structure, and explain the benefits of capital structure. So what is capital structure? Capital structure is a mix between owner's fund and borrowed fund. That is, it is a mix between equity and long-term debt that is used to finance a business operation and growth. Capital structure simply means the capitalization of the business, how the combinations of different forms of capital that were used in financing the business. This means that the capital structure of a business is usually made up of both equity and debt. And this equity can be ordinary share capital or preferred share capital. Let's note that both equity and debt are sources of long-term financing. And when we are discussing about capital structure, we are focusing on long-term financing, long-term equity, and long-term debt. Therefore, capital structure is how we arrange our different sources of our long-term funds. If you are still here, please don't forget to subscribe, like, and hit on the notification bell for future amazing topics. And also feel free to drop a comment or two if you need more clarity. From our definition, we can see that capital structure focuses on the type of security and the mix of the security. And we have said that the type of security can be either equity or long-term debt. And that the mix of that equity and the long-term debt is also an important factor to focus on the topic capital structure. What we are seeing here is that the mix of equity and debt in the composition of the capital structure matters a lot. And the best mix of debt and equity finances that minimizes the firm's cost of capital and maximizes its value is called the optimal capital structure. What I'm saying here is that the optimal capital structure is when the proportion of debt to equity is mixed in such a way that it will result in an increase in the value of the firm. It is a balance between the cost and benefit of a capital mix. It is that point where the firm balances the risk associated with too much debt with the return associated with using cheaper forms of debt or finances. What I'm saying here is that it is the point where cost of capital is at its lowest and market value is at its highest. So what we are trying to say here is that capital structure help us to get a good mix of our equity and debt in order to reduce our weighted average cost of capital. I will discuss more on weighted average cost of capital in our subsequent topics. And this optimal mix of debt and capital help us to maximize the value of the firm and to improve the financial performance of the firm where the returns now exceed the interest costs. That is, it helps to balance out the risk and return associated with various projects and enhance the financial flexibility of the firm. That is, it allows the firm to easily access both debt and equity market when it needs to. And we all know that a well-structured capital helps us to achieve long-term growth in the firm. So how do we evaluate the potentials of a company's capital structure? These informations, they are found in the company's balance sheet, where we can easily evaluate the working capital adequacy of the firm, the asset performance of the firm, and also the capital structure of the firm. So, what influences us to choose a particular mix of capital structure? What influences us to decide the amount of equity and the amount of debt we want to use in a particular project or firm? What I'm asking here is, what are the determinants of capital structure?
The type of capital structure we choose, it depends on the cost of the capital. That is the cost of choosing that capital, because we analyze the cost of the equity and the cost of the debt. Then we choose the one that is more suitable for us. However, debt is more cheaper than equity due to the tax benefit associated with using debt. And we want to have to decide, do we want to maintain the current ownership, or do we want to dilute control and ownership? And the company has to decide whether they want to invite more owners or they want to incur more debt. And the size of the firm matters a lot. You understand that larger firms have easier access to capital. They have easier access to the capital market and to debt option than smaller firms. Apart from the size of the business, even the nature of the business is also a determinant when choosing a capital structure to use. For instance, a car manufacturing company may need more capital than a juice manufacturing company. I'm just assuming that. I've never had the privilege of checking the books of both a manufacturing company and a juice company. Also, the cost of the fixed asset or project that the firm wants to undertake also matters a lot, because the capital structure you want to take, you would want such a capital structure to match the cost of the fixed asset you want to incur or the project you want to undertake. Also, the attitude of the lender matters, because the willingness of the bank and financial firms to provide us with a particular type of capital also influences our capital structure. Also, the legal requirements in the country also matters. For instance, in Nigeria, between April 2024 and May 2026, Central Bank of Nigeria mandated that all banks in Nigeria must meet with a new recapitalization compliance. So you see, you may have to comply with what the legal requirement says. So how do we actually raise these finances? The way we raise finances varies from country to country. In Nigeria, for instance, raising finance through debt is more common than through issuing of equity. The form of the company also affects its ways of raising capital. Like private firms now, they have fewer access of raising debt than public firms. And because of these fewer access all these private firms have to raising debt, they end up using more of their retained earnings or go into venture capitalizations with other partners. If you notice, we have been discussing about how firms raise capital either through internal financing or through external financing. By raising capital through internal financing, it means that the firm is raising capital through its retained earnings. That is, profit plugged back instead of being shared as dividends. While external financing, these are funds that are raised using stocks, warrants, and equity raised from the financial market. It has come to a realization that some firms they prefer internal financing, that is financing through retained earnings, more than external financing, that is financing through debt and equity. Why is this so? This is simply because external financing can be very difficult to access, and they may also be more costly as compared with internal financing. And as we said before, we all know that when you get more external financing, you trade off your control, you dilute your control, because you have attracted more owners into the business. However, our retained earnings is limited. Even if the company does not share dividends and they decide, okay, let us plug back all our entire profit, it may not be enough. And limitation in our retained earnings, it can lead to project delay and even make us lose an opportunity to compete favorably with other firms. And also, it is sometimes very important for us to compare the cost of the internal finance and the internal finance, because if the cost of the internal finance is greater than the cost of the internal finance, then it is a loss. So it means that managers must choose a capital structure that maximizes the value of the firm, because maximization of the value of the firm helps to maximize what? Shareholders' wealth, and that is the objective of corporate finance. and choosing the right capital mix help us to minimize the cost of capital to its lowest possible average weighted cost of capital possible.